everybody. Welcome to the Capital Grounds podcast. This is our third episode. I'm your host, Joe Fisher, and I've got my co-host, Nick Miller, here with me.
Hi, good morning.
We're from SITG Capital, and we're bringing you a podcast to really help our investors just kind of understand a little bit more of what we're doing in the real estate markets, and provide some much needed education around the private markets. So, Nick, how you doing this morning, man?
Hey, I'm doing well. I'm doing well, Joe. How are you?
I'm good. I'm good. It's a little cold here in Dallas, but we don't have to deal with that too much. So I'm happy. I'm happy this is a rare occurrence for us. We'll say that.
Nice, nice. Yeah, the cold, no good, no good, but at least it could be worse, right? It could be worse. You could have
It could. I
ice on
mean,
the roads.
could live in Minnesota like you did for a while, and
Yeah,
experience that up there.
yeah, but at least, we get a lot of snow up there, or we got a lot of snow up there. So there was something. You got some reward for your risk.
Yeah, yeah. I mean, I would way rather have snow than ice for sure.
Yeah, you and me
So,
both. You and me both.
yeah, yeah.
Well,
But let's do our first segment. I mean, we're talking about the cold here. So, Nick, what do you got in your mug today?
yeah. So I'll tell you first off, the mug is something special. It this is I don't know if you can see that, but
Yes,
this is a
I can
mug we
see it.
made for my daughter's first Mother's Day. Oh, Easter 2021. So that's her foot at the time. Uh,
Oh,
yeah, it was really exciting. So
man, that's cute.
Yeah, and actually this morning, I've got some chai tea brewing. Didn't end up doing coffee. Had my first cup this morning of coffee, but switching things up a little bit. So,
Yeah. Well, I was gonna say, where's the grounds, man? I mean, come on, this is Capital Grounds podcast.
yeah, you'll have to give me a free one today because that is not the case. But
Fair enough. Fair enough. Um, well,
yeah, so yeah, go for it. What
first,
do
I
we?
think we should go into our first section, kind of talking about what's happening in the real estate markets, our state of the grounds section. So I pulled a couple articles that I thought were interesting and kind of shows us two sides of what's happening in the markets. The first article is an article about basically building booms in commercial construction, and DFW, where I'm at and where we invest heavily in, uh, is currently second to what metro, Nick? Can you guess?
Second in terms of I'm sorry, new builds
In
or
terms
what's
of
the?
capital, of terms of capital put towards new build construction.
Hmm, I'm gonna have to guess. Well, I don't know, probably the LA Metro. That would be my guess, but no, maybe
Okay,
it's
all right,
Austin.
all right.
Maybe it's Austin. I'm gonna go with
Oh
Austin
man,
because that seems cheekier.
Austin's on the list, which is another market we invest in. LA, surprisingly, is not in the top 10.
You're
So,
kidding. Wow, okay.
no, it's not. It's not. New York is number one.
Oh, okay.
Um,
Well,
and then you've got DFW.
wow.
And then number six, another area that we're heavily invested in, Houston. And number eight, Austin. So basically, this article, Dallas Morning News, highlighting what's going on. There was a 51% increase last year for 2022 from 2021 levels for commercial buildings and apartment starts in DFW. So just a bunch of money being pumped in to the market, ranging from, I mean, that ranges from a lot of things, industrial to, what we look at is more multifamily, which there's a nice chart on there that shows you the top 10. And again, Dallas number 2, Houston 6, Austin 8, all multifamily markets that we operate in. So we feel like we're in a good position from that perspective. But I want to take you to the other side of it. There's a good CNBC video about what's happening in commercial real estate vacancies in San Francisco. They're actually at an all-time high right now. So I don't know if you saw this, Nick, but Q4 of 2019, so right before the pandemic, they were at 3.7% in San Francisco Metro. And then pandemic induced, work from home type stuff, a lot of tech companies
Sure.
there, obviously. So a little bit different job market than what we see here where we're located. But it jumped from 3.7% to 16.9% by Q4 of 2020.
Wow, that's
And
incredible.
yeah, so I mean, a big increase, right? That's pandemic induced, but it didn't slow down. That's the thing, because now Q4 of 2022, those numbers just came out not too long ago, and it's now increased to 27.2% in the
Wow,
San
that's
Francisco area.
incredible. Incredible.
Yeah.
Man, you think about, I mean, imagine an office park, right, where you've got some large players in there,
Hmm.
tech firms that everybody starts working from home. I think it's easy to underestimate the impact that people in the offices have. I work from home.
It is.
I'm happy, love it, right? But
Right. Right.
when you're going to the office every day, going downtown, going to an office park, what have you, there are a bunch of other smaller businesses in those areas that are positively impacted from people being there. So that's
Absolutely.
baffling. Wow, that's a terrible, terrible statistic. Mm,
Yeah. Yeah. But I mean, to me, it just illustrates why you want a good operator to take care of your funds as a real estate investor, because certain markets are going to
absolutely.
outperform others. That's how this thing works. And
It
so
is.
you have to be cognizant of what's happening in the macro and the micro environment, and just be cognizant of what's happening. And we talked about this in our last episode, Nick, but you know job market diversification is very important, because San Francisco, I don't know what the percentage is, but I would assume has, you know, a much greater percentage of tech workers than they do of anything else. So obviously that's hit them really hard, and it's going to be hard for them to recover, because a lot of people who work in the tech industry, they can easily work from home, like you said, and really make it a more permanent thing versus it being a temporary thing.
And, I totally agree with you. And I think it reinforces, we've talked in some of our previous podcasts, and we certainly talk about this
Mm-hmm.
with our clients on a regular basis, that one of the values that multifamily brings is much lower volatility.
Yeah,
If we were
true.
in a position where we had 27% vacancy rates, then that's on us. Then we've made some critical errors in our due diligence to begin with. If you've got over a quarter of your units without people living in them, right?
Right,
Everybody needs
right.
a roof over their head, and thankfully, with multifamily, not the same kind of concern as it is with retail or office space investments.
Absolutely. I mean, yeah, we've talked some about that. Office space, retail in particular, have had a hard time, and I think just really accelerated some of the trends we were already seeing. The pandemic did accelerate some of those trends we were already seeing. So, yeah, we're happy to be in the multifamily space, and we believe that there's still a massive need there, and will continue to be. But doesn't come without challenges, right? Which kind of brings us to our main discussion. We're talking about interest rates. Everybody loves talking about interest rates. Obviously, they're much higher than they were last year in 2022 when we were talking about all these starts happening, which, to be fair, it's probably going to pull back this year because of the interest rate hikes. So we alluded to us talking a little bit about um, interest rates in this episode, in our last episode, and I think Nick, we are talking a little bit about inflation and the correlation with inflation and interest rates. So I thought maybe that would be a good place for us just to start when we're talking about this topic.
Yeah, certainly, certainly. And I apologize. I keep kicking my desk here, so bear with me when the camera shakes. But yeah, at least right now, the primary driver that we see our government working to handle inflation is through, changing the Fed funds rate, right? The
Right.
rate that banks borrow from the Federal Reserve, and that then affects, overnight bank borrowing rates, interbank borrowing rates, and then that trickles down to, business and consumer loans, and that's where it really starts to hit us. Um,
Yeah.
so, it's interesting that we've seen kind of the changes that we have, because it's a night and day difference from where we were, a year ago. Certainly,
True.
year and a half ago. It's complete 180.
Yeah.
Joe, tell me a little bit about what you're seeing. I know that uh, you know, talk with the banks more than I do for a lot of our
Sure.
deals and our projects.
Sure. Sure.
What kind of conversations are you having, with our bankers, and what are the vibes you're getting from them? If you've got.
Yeah. No, I mean, so I think, it's important for us to remember really what historical averages are. Because
Sure.
if we look at SOFR, which is uh, Nick, what's that acronym stand
4.3,
for again?
the secured overnight financing rate,
That's what it was. Yeah, secured overnight financing rate. So it's at 4.3, 4.33 today, something like that, right? So it's
which is
right
right
around
around the.
there.
Yeah,
Yeah, it's right around the average. You're right. I mean, so we're looking at this and we're saying, man, heck, this is high, right? This is extremely high, what we've
yeah,
been used to. But in reality, it's really closer to the average. If you look at the 10-year Treasury note, for example, we're currently around 3.5%, 3.52, fluctuating in there. Um, However, the historical rate for the 10-year Treasury is 4.26%. So I think you have to have some context and remember, one of our partners, one of our, our main operator has been doing this for over 30 years, and he was successful when rates were much higher. Um, and if you actually go, you can pull up a chart on the federal funds rate, and I'm looking at a 62-year historical chart right
yeah.
now in front of me. We go back to the 80s. I mean, we were in the close to 20%. The highest they got, I think, was 19. Yeah, right about 20% if you round up. Um, but yeah, if you look at that, and we are currently at 4.33, we're just slightly under average. So, you know, like I said, we're not in the worst position from an interest rate standpoint. Now, debt got more expensive, which makes deals a little bit more difficult, and it's harder to agree to terms. I think there's some market dislocation, which we're going to talk about in another episode, in the sense of sellers want X amount of dollars, but buyers are only willing to pay X because the cost of debt has increased so much in such a short period of time. So I do see that happening a lot. Um, but I think, Nick, maybe you should talk a little bit about, um, maybe explain a little bit about what the FOMC does, and kind of what we're looking at, and what we can even give predictions. Obviously, guys, we're not, we don't know. Economists can give predictions and they don't know where rates are going, but let's talk through it a little bit and kind of see where our head's at on it.
Yeah, yeah. Well, I'll tell you, I'll just lay out my personal thoughts, right?
Sure.
I think that our current environment, people have a bit of shell shock. I'm going to call it, from the rapid rate that rates have increased over the last 6 to 9 months. And for me and the business that we do, I'm okay with that. I'm okay with that. I think it's gonna cut, we're gonna cut a lot of operators that haven't been able to manage their properties well. I mean, look at the off-market deals that we're getting offered,
Yeah,
Uh,
you're right.
this is the time for people that know what they're doing to go in and to, make some great buys and make some good money. And if some of our peers are a little concerned because of the sudden increase in costs and rates, um, then we'll continue taking the opportunities as they present themselves. I, like you mentioned, when we look historically, the rates we're at right now are really not that bad. If people want to let recency bias get in the way of what they're trying to do, and certainly, you know, it trickles down, and the end result numbers do not look as great as they have the last couple of years. But
Yeah,
certainly there's still a lot of opportunity to be presented. So I think, uh, gosh, my hope is that as the news cycle kind of normalizes over the next 6 to 9 months, I think we're going to see a level off of rate increases. And gosh, I would love it. Maybe we sit here, we sit at a flat amount for a year, 12, 18 months,
sure.
and then we'll see what the economy looks like then and go from there. But uh,
Yeah, yeah,
I really don't think we're in a bad position yet. What are your thoughts?
yeah. I mean, I tend to agree with you. I think maybe we'll see a few more rate hikes. I don't think near as drastic as we saw last year. Maybe a 1/4%, 0.5% at most, if inflation data is bad. But we already see inflation cooling to a degree, and so
Mhm.
we talked about that correlation between inflation and rates, right? Rates
Yeah,
usually trail inflation because the Fed's always trying to keep up with basically what inflation's doing, and go back to that arbitrary 2% mark that we talked about. So I think we'll see a leveling off. I agree, and I think who knows how long it'll take, but I think rates will come back down, which again eventually presents an opportunity. Nick, you're bringing up some good points about what we have available to us this year. Doesn't come without challenges because it's more
certainly.
expensive and it's harder. It is harder to obtain debt, even if you have a good track record and a you know good lenders and good partners to be able to do all of it. It's still harder. But I will say this. So to give you an example, we're in contract on a property right now. It's not closed, so I'm not going to give you the name, but it's a little over 400 units. Um, we're buying it for about 80,000 a door right now. Okay, and there was an opportunity, I think, last year for them to sell well above 100,000 a door, maybe even close to 120. There's some comps in that area that were at 120. So yeah, for us, that's a good opportunity, but because the cost of debt has increased so much, really buying it last year at 100 or so is fairly equivalent to buying it this year at 80. But the difference is we're really long-term investors. So we're not looking to exit, as quickly as possible, which means we'll eventually have a chance to refinance that property. And because our cost basis is so much lower, it's a much better return long-term for us than if we would have bought last year.
Yeah, I agree with you. I agree with you. And with our partnership with our elite operator, I think we're in a really great position. We've got the best of both worlds. And yeah, you're right. Things are a bit more expensive, but with what we're able to do in the wiggle room, if you will, that we've got when we're looking at a deal, it's I think the situation would have to become quite a bit uh, quite a bit worse uh, before we're in a situation where the numbers stop making sense. And even then, I mean,
Yeah,
really, I think
yeah,
right now this is where the good operators are being separated from the not so good operators, if you
it
will.
is. Yeah, yeah. I mean, a lot of people got into this market over the last few years, and rightfully so. I think there was a ton of opportunity. But yeah, now you are seeing you have to be good now to be able to hold on through this and and to grow through this. I think that that's maybe even a little bit tougher. So, we're kind of touching on it, but I want to talk a little bit more about kind of how we in general handle increasing rates. And that's one way. We're going to do our due diligence. We're going to get a property for uh for a good price. We're not going to overpay. I mean, we'll let a property go before we overpay, right? But another way we do it is with rate caps. And we could probably do a whole episode, Nick, on rate caps. They're super interesting. Maybe we will, because there's a lot that goes into them. But I think one thing that I didn't fully understand when I first got into real estate was why is everybody on on a variable rate, right? Like that
Sure.
didn't make any sense to me because I'd only done single family homes. I thought, yeah, you lock that rate in while it's low. Why not, right?
Absolutely.
Um,
That's what people preach that all the time, right? Oh, don't do an
yeah,
ARM. That's
absolutely.
what caused the 08, 09, amongst other things,
Right, right. But I think what people have to understand when it comes to these large commercial properties, these multifamily properties we're buying, and others are buying, there's huge percentage wise repayment penalties if you have a fixed cost to it,
Fi-
right?
Fixed rate loan.
Yeah, fixed rate. Yeah, versus a variable, or an arm, or something like that. You have to pay, sometimes 20% in order to get out of that loan. So if you do the math and you sit down there and you look at the property, right, and you say, well, rates could go up this much, right? That's a possibility. Most of the time, it's better for you to actually do the variable rate than it is the fixed rate, and that's where rate caps come in. So that's an area where we'll buy a rate cap in order to protect ourselves from it really getting out of hand. Which, like I said, we could do a whole podcast on that, Nick, because last year rate caps went crazy even from a trading perspective. So that's an interesting area of the market, I think.
Yeah, I agree with you. I agree with you. And, like we've talked about before, the risk of, I mean, in what we do, right? You certainly
Mm-hmm.
can't predict the future. If you're buying an investment property as an individual, if you're buying a primary residence as an individual, you're looking to hold that property for, a period of time, right?
Right.
I mean, rarely do people, not in what I would say, not in good financial situations, do people buy a property speculatively, and plan to hold it for a short time. Whereas with what we do on the multifamily side, you might have a property that we've purchased, we've gone in and added value, and our game plan is to hold it 5 or 10 years, right? And
Mm-hmm.
then year three, as we're wrapping up renovations, somebody could come to us and say, "Hey, we like this. This is what we're going to throw this number at you." And it could make a lot of sense to sell, right? And
Yeah,
if you had a fixed rate loan and had to pay 20% prepayment penalty, that's going to crush the deal. And at the end of the
absolutely.
day, we have to be good stewards of our own money, and certainly more importantly, arguably, our investors' money. And
Right. 100%.
it's constantly a balance. But yeah, rate caps. You could, buy them for pennies on the dollar, what, 2 years ago.
Yeah.
And
Yeah.
I mean, it was a bargain. And
And
now they're
then,
just
fast forward to end of 2022 or even middle of 2022, and rate caps were killing deals, because they were too expensive. So yeah, it's just
absolutely.
crazy how quickly the market can turn. So you got to be prepared. You got to be prepared because interest rates are an animal in and of their own, and we don't have any control over that. We just have control over what we can control, and that's finding good deals, and like Nick said, protecting our money, protecting our investors' money, from these types of situations.
Absolutely. Absolutely. And I will say, we've talked about this, and maybe this is worth doing an episode down the road, but you and I have talked about the value of having a relationship with your lender, right? Having
Yeah,
an
right.
ongoing relationship with them. Certainly, you want to compare, do your due diligence on other offerings out there to keep you both honest, right? But
Yeah.
when you've got a long-term relationship with a lender, hopefully they're able to, hopefully they're able to understand the business that you do, and hopefully there's some value there. But um, yeah, rate.
No, I agree.
Joe, what do you think rates will do? Where do you see us
Mm,
ending the year? What's your prediction? I'm going to tee you
man,
down to a specific number.
okay. So where are we at right now? We are at are we at 4.3? You want to go the 10-year treasury guess or SOFR guess?
Sure.
What
Yeah,
rate?
yeah. Let's do 10-year.
Okay.
Yeah, here I haven't checked it today. Do you know what
I don't know
would you
what it
say
is today.
today's
Check it.
was? Okay, I'll check. Bear
Check
with
the
me.
10-year today. Let's see what it is. SOFR is like 4.33. So we can make an assumption on SOFR, and
Sure.
then we'll make an assumption on the 10-year. So I don't think SOFR's going that much higher. Like we talked about, we're pretty close to the average. So I'm going to say that it just gets over 4.5 by the end of the year. That SOFR does.
Yeah, and as of close of business yesterday, we were at 4.3. Um, so you think 4.5, no more?
Yeah, I think between 4.5 and 4.75 is where we're going to be at SOFR. I think it'll level off. I mean, we're seeing inflation start to level off. But what do you think, Nick?
Yeah, I'm gonna say the upper end. I'm gonna say 4.75, 5. Think somewhere
Okay.
in that range, maybe just over 5. Gosh, I certainly hope not. I would love for you to be right, but yeah, I think that's where we might sit. So
Yeah. No, that I think that's a great guess. As far as the 10-year T, I'm gonna say 3.8, somewhere in there.
okay, okay. Yeah, I'll stick with that. I'll stick with that. But Joe, I think this
Okay.
might be a good
All right.
opportunity for us to take a quick pause here, tell our listeners and viewers a little bit about SITG, and then we can come back to it and get back to interest rates.
Yeah, let's do it.
All right, here we go.
Check us out at sitgcapital.com. We got a full list of our current portfolio, current investments that you can be a part of, as well as some educational material that kind of ties into what we're doing here with the podcast. So thanks for listening to Capital Grounds. And again, check us out at sitgcapital.com. Thanks.
All right, welcome back. Thanks for hearing a bit about what we do and why we do it. Joe, I was thinking over the quick break here. You brought up the new housing starts in DFW, or the new building starts in DFW,
Yeah.
and it's interesting to me that there's such a lag, and it makes sense, right? That there's such a lag
Mm-hmm.
between, or I would expect there'd be a lag in a lot of situations between when you lock in a rate and when you actually start to break ground on a project. And you look at 2022, lots of great numbers, but interest
Yeah.
rates were rising and rising quickly. And I think
Yeah.
it
Yeah. Yeah.
speaks to how
Right.
much, yeah, time and effort goes into a project before you actually, you know, put shovel to soil.
Yeah. Well, absolutely. I mean, I'm directly involved in that side of it. And depending on where you're doing the project at, it can take, obviously months and sometimes upwards of a year. In some cases in Austin, 2 years to get to groundbreaking. And so that obviously costs money. But I think what you're seeing last year, if we go back to that article that we were talking about at the beginning with new construction starts, was
Yeah.
people were able to lock in, their rate pretty low last year before things really started to take off and get everything lined up to build. People are smart. They saw the writing on the wall. They knew rates were going to start to rise. So if you had a project that was in the pipeline, you were trying to get it as quickly as possible to a place where you could get funding. so that
You could lock
you
down
could
that
break
rate.
ground. Yeah, exactly. Lock down that rate. And so I think that's why there was such a huge increase last year, and particularly in the Texas cities. You know, Dallas had 16.7 billion in commercial construction starts dollars. And then, you know, Houston and Austin were both in the top 10, and actually exactly the amount, if you combine those two, 8.7 billion for Houston, 8 billion in starts for Austin. So DFW, you know, doing what those two are doing combined. So that's a pretty crazy stat.
Yeah, that's wild. That's wild. And yeah, it'll be interesting to see what the numbers look like here for 2023. And
Yeah.
if and when, rates start to go down, I'll be curious to see what that delay period looks like, and boy, imagine if and when rates go back down, there's going to be a lot of excitement there. But hopefully we can still make some great purchases in the meantime. It's interesting. We talk with clients about the value that we provide with our funds over
Hmm.
whatever they're getting. I mean, even if you're getting 3.75%, 4% on your savings account, that's a great rate, right? That's a great
Yeah.
rate.
Right. Right.
Uh, we're still able to provide uh, uh, significantly more, in income.
Hmm.
Granted, there is more risk than what's in an FDIC insured, savings account, certainly.
Yeah.
But arguably, well diversified portfolio of, cash flowing properties. Uh, uh, risk is always difficult to quantify, but it's still a really great option for that cash lying around. And
It
certainly
is.
with some of the ways that we're able to provide income without creating tax liabilities for clients.
Yeah.
But
Right.
I'll be curious to see how quickly how quickly banks drop those rates, if and when rates start to go
Uh,
down.
yeah. I mean, I'm not sure, but I mean, you do bring up a good point, right? If your money's just sitting there, we talked about inflation in our last episode. It's getting beat up by inflation. You can go get an FDIC savings account for 3.5% at least, Nick, something like that, right? And
Yeah, maybe.
that's pretty great, you know. But yeah, we our funds can do we do 10% for our fund. It's tied to real assets, like Nick was mentioning. It's tied to our apartment complexes. So if you actually look at risk adjusted rate of return, and I think we've talked about this before, but we have some education on our website around it too. Multifamily real estate in particular has the lowest risk adjusted rate of return. So the risk is in line with with corporate bonds, and then the return is slightly higher than the stock market, at least over the last 20 or so years. So, we really look at what you're going to get in this type of environment for the amount of risk you're taking. And with rates increasing, there are still places for you to put your money to work, is really what we're saying.
Yeah, one of the highest, risk adjusted returns. Yeah, yeah. You get
Yeah, you're
the
right.
most,
I'm sorry.
no, that's all
Yeah.
right. You get the most bang for your buck, dollar for unit of risk, right? That's the beauty of what we
Yes.
do. And again, especially in, we invest in areas where there's massive growth going on, and often, there's an existing, a natural housing shortage that needs to be resolved, but then
Yeah.
you throw on the growth that those cities are experiencing at the same time, and it just compounds the problem even more. um, you know, people people need roofs over their head, man. You can't
They
we
do.
have
Yeah.
a huge homeless population in the US, and
Hmm.
lots of people we can be helping.
Yeah. Yeah.
And we
Which,
improve our communities while we do it.
yeah, absolutely. Absolutely. But I mean, to your point, there's a huge there's a huge need, and I know the number specifically for Dallas off the top of my head because I'm I'm ingrained in it every day. But Dallas added a little over 250,000 jobs just last year for 2022, and only 50,000 new units were brought to market. 50,000 seems like a lot, especially if you're from a small town like Nick and I, not even fathomable, right? But the reality is 250,000 jobs. I mean, you should really have one new housing unit for every two jobs, right? So really, what is that, Nick? Maybe 75,000
125.
units um, that we're
Oh,
short
deficit.
overall. Yeah,
Yeah,
that there's a deficit of
at
at
least.
least. And it's been going on for years. So I do think when interest rates start to come back down, we will ramp back up even more from a construction standpoint. So, that's why we're still aggressively buying right now. Obviously, we got to get a good deal, but with rates being higher, we still feel comfortable going out and purchasing property because eventually rates will come down and it will be easier to get financing again and go out and start to hopefully fill some of this need that's out there across these growing cities.
You know what? Yeah, I think you're dead on there. And I mentioned this or alluded to it earlier, but I find it interesting when you look at the environment we were in, 05, 6, 7, 8,
Mm-hmm.
where uh, regulations were a bit more lax and people were buying up homes and speculating on homes. And
Yeah,
at the end of the day, those who speculated got burned, right? Now, we're in a situation where the rates were so low that you could take an arguably a bad deal, or you could be an operator that didn't have a lot of experience or did it poorly, and you could buy a
yeah,
property and you could make money.
you're right.
Uh, but,
Quick quiz for you. Were
uh-oh,
rates higher or lower in 2007
they were
than they are
higher.
right now? They were higher.
Yeah,
You're
they were
right.
higher. Yeah,
They
yeah.
were at 5.3 in that range, 5.2 versus where we're at right now, which we talked about is 4.3. So yeah, they were higher. People were still speculating like crazy before they fell off a
Man.
cliff. So
Yeah, yeah. And so now, like we talked about earlier, now you're in a situation where, those that made poor decisions or gambled and
yeah,
lost, uh, firms like ours and other great operators are able to step in and prevent those families from, facing a lot of turmoil and those properties from being in rough shape. So
absolutely.
good. Well, I think that's a good lead in to the last bits of our talk today. Next episode we're going to be talking about real estate investment trusts, REITs,
Hmm.
because they're pretty controversial. They're at
Yeah,
least from my experience, and Joe, I would imagine probably yours too. Um, you know, there's a lot of potential value in real estate, but
there
we
is.
talked to a number of clients who have had poor experiences in REITs, publicly traded,
Yeah,
um, which we'll get into. But yeah,
yeah,
it's
yeah,
interesting. I'll be excited to talk about how rates affect REITs, and historically they've trended to perform well, depending on the time frame as rates increase, but when you've got a situation like we're experiencing now, where you've got rapid rate increase,
hmm,
data suggests it's not the place to be. Um,
right,
but we can dig more
right.
into that, next call, next cast.
Yeah,
So check it out. Joe, any other last minute thoughts, ideas, comments?
I would just say if you're listening, just remember, we're doing this for our investors. We're doing it because we enjoy it, but we want to make sure we're putting out good educational material for you guys, to help you get more comfortable investing in general, really. So send us your questions. You can email us. You can go to our website and find, our contact info there, our email there. Yeah, but please send us questions, comments, what ideas for other episodes you'd like to hear us go over, whatever you got. We'd love to hear from you.
Certainly, certainly. And check out the website. I think there's a lot of great information on there. We are always open to positive and constructive feedback.
Yeah, so visit us, sitgcapital.com. And yeah, we'll put it all up on the screen for you guys too, so you can get there easily. But thanks for joining us,
So
Nick. Thanks for your time, man. It's always a joy.
likewise, Joe. Good luck. We'll see what the day brings, and we'll talk again soon.
All right, take care.
All right, we'll see you.